Imagine you are tasked with building like $1 billion artificial intelligence supercomputer.
Sounds incredibly stressful right out of the gate.
Oh, totally. But let's say you do it. You've managed to secure tens of thousands of the absolute fastest, most advanced GPUs on the planet. You've got this massive power grid hooked up. You turn the system on, ready to train the next massive language model, and then suddenly the entire system just crawls to a halt.
And it's not because the processors aren't fast enough, right?
Exactly. It's not the brain. It's because the microscopic electrical signals traveling along the copper wires between the servers are literally degrading into pure noise. So the bottleneck isn't the brain at all, it's the nervous system.
Yeah, and that is, it is the ultimate irony of the AI infrastructure boom right now. We have hyper-focused on processor speeds, but the physical reality of moving petabytes of data across a data center at light speed is creating just an absolute physics nightmare.
And solving that specific nightmare is exactly why we are here today. Welcome to today's deep dive. We have a seriously dense stack of equity research to unpack today, and it's centered entirely on a presentation titled Astera Labs ALAB AI Infrastructure Deep Dive .pptx.
Right, Astera Labs.
Yeah, trading under the ticker ALB. If you are a new retail investor, trying to find your footing in this wild AI space beyond just buying NVIDIA or Microsoft, understanding this company is crucial.
It really is. It's a masterclass in how modern tech monopolies are built. They aren't doing it by making the flashiest consumer product, but by owning the most boring, mission-critical bottlenecks.
The picks and shovels, essentially. So our mission for this deep dive is to tear apart Astera's underlying business model, examine the actual physics and complex connectivity tech driving their explosive growth, and then contrast their market dominance against some pretty massive existential threats.
Because there are definitely threats out there.
Oh, massive ones. And finally, we are going to look at the valuation. Because, spoiler alert, the multiples on this stock are completely extreme. We need to figure out if buying in right now makes any mathematical sense for your portfolio.
Yeah, the tension between their underlying technological dominance and the current reality of their stock price, well, it's one of the most fascinating dynamics in the market today.
So let's start with the business model, because it explains how a company founded in, 2017?
Yeah, 2017.
How a company that young can generate such staggering numbers. Astera Labs operates as a Fabless semiconductor company, so they outsource the actual physical manufacturing of their hardware to heavyweights like TSMC.
Right, Taiwan Semiconductor.
Exactly. This means they're pouring basically all of their capital into intellectual property, the design phase, and their Cosmos software platform, rather than, spending billions building their own fabrication plants.
And that structural choice, that is the foundation of their entire financial profile. By avoiding the massive capital expenditures required to actually bake the silicon, they maintain incredible agility.
Right.
They design the architecture, TSMC basically pours the concrete, and then Astera sells the finished product to blue-chip hyperscalers. We are talking Microsoft, Google, Amazon, Meta.
Okay, let's unpack this with an analogy to really ground what they are actually selling to you.
Hello.
Think of Astera Labs as an elite city planning and engineering firm.
I like this.
So the hyperscalers are trying to build out a massive metropolis of skyscrapers. Those are the GPU clusters. Astera comes in and designs the ultra-high-speed multi-lane highways connecting every single skyscraper. They get TSMC to lay the asphalt. But here is the brilliant part.
A toll booth.
Yes. Astera doesn't just hand over the keys to the highway. They also install the traffic management software that's the Cosmos platform, and they effectively charge a toll for the ongoing telemetry and management of that traffic.
What's fascinating here is the financials of that toll booth model. It is what every investor needs to pay attention to. In fiscal year 2025, Astera pulled in $541 million in revenue.
Wow.
Yeah. But out of that, they generated a 76.4% non-GAAP gross margin.
Wait. A hardware company pulling software-level margins? Like 76.4%?
I know, it sounds crazy.
That implies they have absolute pricing power. You don't see margins hovering near 80% if you are just selling commodity cables that any generic manufacturer can replicate.
Exactly, and you've hit on the core thesis there. If you are a hyperscaler deploying a $2 billion AI server rack, you are not bargain hunting for the connective tissue.
Right, you're not going to buy the discount cables for your billion-dollar supercomputer.
No. A single signal failure can crash a massive training workload, and that costs millions in lost compute time. So Astera charges a massive premium because their hardware guarantees signal integrity at blistering speeds. And because of that pricing power, they are sitting on a literal fortress balance sheet. Zero long-term debt.
Zero.
Zero. And $1.1 billion in cash and equivalents.
Okay, having $1 billion in cash with zero debt in a high interest rate environment that gives them a massive strategic weapon. They can burn, what, $60 million a quarter on R&D without even blinking, just pushing their technology forward while smaller competitors are out there struggling to secure loans just to keep the lights on.
Yeah, and that R&D spend is vital because the traffic jams they are trying to solve are getting exponentially worse with every new generation of GPUs.
Which is a perfect segue. Let's transition into that technology because to understand why Astera's revenue just jumped 93% year over year in the first quarter of 2026, we really have to look at what happens when you plug thousands of next-gen NVIDIA chips together.
Yeah, it's a lot of data.
The research outlines the massive data transfer demands created by the H100, the B200, and especially those GB200 NVL72 racks. Astera's primary hardware solutions here are their Aries retimers and Taurus Ethernet smart cables. But I want to push on the how here. The presentation mentions PCIe signal degradation.
Right.
Why does data suddenly degrade just because it's moving fast?
Well, I mean, it really comes down to just the fundamental physics of sending electrical impulses through copper. When you push data at the speeds required by AI, and we are talking gigabytes per second across a server rack, the high-frequency electrical signals experience extreme attenuation.
Attenuation meaning they fade out.
Basically, yeah.
Yeah.
They literally lose energy as they travel down the wire. You also get crosstalk, where the signals interfere with each other, and jitter, where the timing of the data packets gets misaligned. So by the time the signal travels just a few inches across a motherboard, what started as crisp digital 1 or 0 looks like distorted noise.
Okay, so the receiving processor gets this garbled mess and essentially has to say, hey, I didn't catch that, send it again, which introduces latency.
Exactly.
And latency is the absolute enemy of AI training.
Precisely. And this is where the Aries retimer comes in.
Yeah.
It is a highly specialized piece of silicon placed physically along the data path. It intercepts that degrading noisy signal, completely unpacks it, strips out the noise, reclocks the timing to perfect precision, and then transmits a fresh, pristine signal down the next leg of the journey.
So it's like a signal booster on steroids.
Yeah, it is active signal regeneration.
Mm-hmm.
And the Taurus smart cables perform a similar miracle for the Ethernet connections linking disparate racks together across the data center.
Here's where it gets really interesting, though. The research spends a massive amount of time on something completely different. CXL technology, or Compute Express Link. Astera builds Leo memory controllers specifically for CXL. The analysts claim that the adoption of CXL 3.0 over the next year could expand Astera's addressable market by 10 times.
10 times, yeah.
Bringing it to a $15 billion total addressable market by 2027. But wait, I have to challenge this. Isn't memory just memory? Like standard RAM. We've had memory upgrades in computers for decades. Why is CXL the magic bullet that suddenly reshapes the entire architecture of a data center?
That is the multi-billion-dollar question, honestly. To understand CXL, we have to look at the historical bottleneck of computing itself. Traditionally, every CPU or GPU has a fixed amount of memory physically wired directly to it.
Right.
It is a strictly one-to-one relationship. But large language models are extraordinarily memory hungry. We have reached a point where the GPUs are insanely powerful, but they spend an unacceptable amount of time just sitting idle, waiting for data to be fetched from their local memory.
It's like having a genius mathematician who can solve any equation in a second, but they are working at this tiny, tiny desk, have to keep getting up, walking down the hall to the library, and fetching one book at a time. So the brain is fast, but the access to information is totally bottlenecked.
That is the perfect way to visualize it. AI is no longer just compute constrained. It is severely memory constrained. Compute Express Link, or CXL, fundamentally breaks that old architecture. It is an industry-standard protocol that essentially decouples the memory from the processor.
Oh, really?
Instead of every GPU having its own isolated tiny desk, CXL creates a massive shared dynamic reservoir of memory that any processor in the entire server cluster can dip into exactly when it needs it.
Okay, so it pools the memory. A GPU that needs a massive spike in memory to process a specific layer of a neural network can just borrow it from the pool and then release it back when it's done.
Yes, it destroys the siloed approach to data center design. But pooling memory across different processors with zero latency requires incredibly sophisticated controllers to manage who gets what data and when. Astera Labs is currently the industry's only pure-play CXL specialist.
The only one.
The only pure-play one, yeah. They were the first to market with CXL 2.0 tech, and their LEO controllers act as the ultra-fast traffic cops managing this massive shared memory pool. Because this solves the single biggest hardware limitation in AI right now, their market opportunity just explodes.
Okay, so if we put this all together for you, they have software-level margins on hardware, they have a pristine balance sheet, zero debt, and they are dominating the exact technology that solves the worst bottleneck in the hottest sector on Earth. It makes total sense why they hold a 55% market share in AI fabric connectivity.
It's a commanding lead?
But, extreme profit margins are basically a dinner bell for the rest of the tech sector. If there is a $15 billion pie sitting on the table, we need to look at who is trying to take a slice and whether Astera's moat is actually deep enough to survive.
The competitive landscape is definitely intensifying, no doubt about it. You have giants like Broadcom, ticker AVGO, circling the space. But Broadcom is a massive conglomerate. They design custom ASICs and generalized networking gear, but they lack the laser focus on pure AI connectivity that Astera has.
Right, they're doing a bit of everything.
Yeah. Then you have Marvell Technology, ticker MRVL. Now, they are a very real direct threat in the retimer space. However, the analysts note that Marvell is playing catch-up regarding CXL integration.
Okay, and the sources also mention Montage technology, but it looks like they are largely geo-fenced within the Chinese market. And Microchip, which seems heavily reliant on legacy architectures rather than next-gen AI fabrics, it sounds like Astera's real defense against these traditional semiconductor rivals isn't just being first, it's the software. We mentioned Cosmos earlier, but how does a traffic management dashboard actually create a competitive moat? What makes it so sticky?
Well, it comes down to fleet-level telemetry and predictive maintenance. When a hyperscaler installs tens of thousands of Astera retimers, the Cosmos software links all of them into a single unified nervous system.
Ah, okay.
The data center operators get real-time, microscopic visibility into the health of every single connection. They can see a signal starting to degrade weeks before a cable actually fails, allowing them to replace it without downtime.
Which saves millions.
Exactly. So if you decide to switch to a cheaper Marvell retimer for your next server rack, you lose that unified dashboard. You break the nervous system. The switching costs, both in software integration and operational risk, they become prohibitively high.
But there is a glaring, massive vulnerability in this research report. Let's look at the bear threat here, customer concentration. A staggering 80% of Astera's revenue comes from just 3 companies. Microsoft accounts for 40% of their entire business. Amazon is another 15%, with Google rounding out the rest.
It's heavily concentrated.
Having your entire business reliant on 3 companies is terrifying enough. But the sources point out something worse. Microsoft, Amazon, and Google are actively spending billions developing their own internal custom silicon. Microsoft has the Maya 2. Amazon has Trainium 3. Google has the TPU V5. If your 3 biggest customers are actively building their own hardware to replace outside vendors, isn't that a ticking time bomb?
It is absolutely the single largest fundamental risk to the business model, no question. If Microsoft decides they no longer need Astera, 40% of Astera's revenue vanishes overnight.
Yeah.
But if we connect this to the bigger picture, we need to look at the engineering reality of what these hyperscalers are actually building.
Okay.
Yes, they're designing their own custom AI processors to reduce their massive financial reliance on NVIDIA's GPUs. But building a proprietary compute chip is a completely different engineering discipline than building the universally standardized high-speed connectivity fabric that links thousands of chips together.
So you are saying even if Microsoft successfully deploys a massive cluster of their proprietary Maya 2 chips, those chips still have to talk to each other, and they still have to interface with the rest of the standard Ethernet and PCIe infrastructure in the data center.
Exactly. The hyperscalers actually face what we call a plumbing paradox. The more custom and proprietary their processors become, the more they rely on standardized, deeply co-designed connectivity gear to ensure their custom chips can actually communicate seamlessly across the network.
That makes a lot of sense.
Astera's edge is their deep ecosystem integration. They work directly with CPU and GPU designers years in advance to ensure their retimers work flawlessly. Hyperscalers are heavily incentivized to use Astera for the plumbing, mitigating the risk of their experimental custom chips failing due to a simple signal routing error.
They might build their own brains, but they don't want to risk building their own nervous system when Astera already offers one with 0 latency.
Right. And Astera is fully aware of this concentration risk. They are aggressively pushing into Tier 2 cloud providers and enterprise AI segments to diversify, though that transition will take several quarters to materialize in the revenue breakdown.
Okay, let's step back and look at the whole picture for the retail investor. We have established an incredible business. They possess the vital CXL tech, they have software-enforced margins, and they are deeply embedded in the hyperscaler plumbing. But a phenomenal company can still be a terrible investment if you buy it at the wrong price. Does the current valuation reflect reality?
This is where the gravity of the market comes in. The equity research is extremely cautious here, giving Astera Labs an overall rating of whole D with a middling fundamental score of 55 out of 100 and a very weak technical score of just 40 out of 100.
Yeah, and the numbers explain why. The stock is currently trading around $320 a share. But the analyst consensus price target, where the street thinks this should be valued over the next 12 months, is just $235.83. We are talking about a stock trading 36% above its target. The market has priced in not just growth, but utter perfection.
Priced for perfection almost understates the multiples we are seeing. Let's look at the price-to-sales ratio. Astra is trading at 54 times their revenue.
54. To put a 54x price to sales into perspective for you, NVIDIA, the company driving this entire global AI revolution, trades at roughly 25 times sales. Marvell, Astra's direct competitor, trades at 12 times sales. Astra is carrying a revenue multiple more than double that of NVIDIA. And their forward price-to-earnings ratio, meaning what investors are paying today for every dollar of profit expected next year, is sitting at 204x.
Multiples like that leave absolutely zero room for error. When you pay $204 for a single dollar of future earnings, any slight delay in product rollout, any microscopic loss of market share, or even a broader macroeconomic slowdown in data center spending will cause the market to aggressively reprice the stock.
So what does this all mean? It sounds like we're looking at a phenomenal band, right? They write perfect songs, the crowd loves them, the venue is packed. But as a new investor, you are walking up to the box office and being asked to buy scalped tickets in the back row for 10 times the face value, one slightly off note on stage, and the market will turn on them. Let's walk through the actual scenarios the analysts present, starting with the bull case. How does a stock this expensive go even higher to their $380 bull target?
The bull scenario requires an uninterrupted AI capital expenditure supercycle. It relies on the hyperscalers successfully investing over $300 billion into AI infrastructure by 2026, with Astera maintaining that 55% market share. It assumes the CXL 3.0 adoption goes off without a single technical hitch.
That's a lot of things that have to go right.
It is. But the most realistic driver for a sudden spike to 380 isn't just earnings. It is an acquisition. In a market this hot, a giant like Broadcom or even NVIDIA might decide that instead of spending years trying to compete with Astera's CXL controllers, it is simply cheaper to buy the entire company at a massive premium.
Wow, okay. But the bear case is severe. The research outlines a downside target of $150 to $180. That is a brutal 50% haircut from current levels. How does that happen?
Well, the bear case doesn't even require Astra to fail. It just requires them to grow slightly less fast. If macroeconomic pressures like sustained high interest rates force Microsoft or Amazon to delay building a few data centers, Astra's revenue growth might drop from 90% down to 40%.
Still great growth, though.
Growing at 40% is an incredible business achievement, but Wall Street will not support a 54x price-to-sales multiple on 40% growth. The multiple will compress down to a more normal 20x or 25x, instantly cutting the stock price in half. You also have the looming threat of lockup expirations, where early insiders and venture capitalists are finally legally allowed to sell their shares, which can flood the market and suppress the price.
Timing is critical here. The research points out two major catalysts. First, Computex 2026, which wraps up today, June 5th. Any announcements regarding next-generation server architectures could directly impact Astra's demand models. Second, we have their Q2 earnings coming up in August. Management has guided for $195 to $205 million in revenue. Given the valuation, a simple beat and raise might not even be enough. They have to obliterate those expectations to justify the premium.
Which leads directly to the action framework recommended by the analysts. This raises an important question for you about risk tolerance. For a new retail investor looking at this space, the directive is clear. Avoid initiating a position at the $320 level. The risk-to-reward ratio is skewed heavily to the downside right now.
So be patient.
Exactly. The recommendation is to wait for a broader market pullback or a multiple compression event to enter the stock closer to the $235 to $250 range. If you already own shares from a lower entry point, hold them, but consider setting a protective stop loss around $260.
It is the classic investing conundrum. Identifying a revolutionary company with phenomenal tech is only half the battle. Identifying a mathematical entry point that protects your capital is the other half, and right now, Astera Labs demands a premium that requires literal nerves of steel. To summarize our dive today, Astera has built a highly specialized 76% margin toll booth on the AI superhighway. They are solving the critical physics problems of data transfer, and their CXL technology is poised to unlock the memory bottlenecks holding back next-generation language models. But they are operating in the shadow of trillion-dollar hyperscalers who could change their hardware architecture at any moment, and their stock is priced as if nothing will ever go wrong.
Yeah, you really have to separate the admiration for the engineering from the reality of the equity market.
Before we wrap up, there is one final, larger implication from this research that we want you to consider.
Yeah, think about the ultimate long-term endgame of all this connectivity technology. The stated goal of innovations like CXL and perfectly tuned retimers is to make data transfer utterly instantaneous and completely friction-free across the entire data center. But if Astro succeeds completely, if they engineer a future where the infrastructure works flawlessly without the need for active management or constant hardware upgrades, does the value of their network eventually disappear?
Oh,
If the AI gold rush reaches a point where the tracks are perfectly laid and never break, does the company selling the picks and shovels eventually engineer themselves out of a customer base?
something to think about. That is all we have for you today. Keep learning, keep questioning, and we'll see you on the next deep dive.